Inflation has been a persistent challenge for many West African economies. However, recent figures suggest some progress in taming price increases in Ghana and Nigeria. But is this just a temporary reprieve, or is the region finally turning a corner? Let's explore the factors behind these trends as Dumebi Oluwole, senior economist at Stears Inc, joins me for more. Hi, Dumebi. Thank you for joining me today. Good morning.
Thank you for having me. Good morning.
Right. Inflation has eased in both Ghana and Nigeria. Were these declines as expected, and what are the key factors driving them?
Yeah, primarily the declines were expected. So starting with Ghana, we did expect that base effects will still continue to favorably impact the headline inflation rate. And that's why we did see that decline in their headline inflation rate. We also have seen food prices and also non-food prices in Ghana taper, at least on year on year, and we did expect that was going to positively impact price pressures in Ghana, and that's those are the contributing factors basically to Ghana's inflation rate decelerating. Then moving on to Nigeria, a couple of things were in favor of Nigeria's inflation actually declining within the period. So, but again, it was primarily base effect. So as of July last year, we did see a sharp, increase in the month-on-month inflation rate. And that the fact that we're coming from a high base in July 2023 and in July 2024, we did expect that inflation was going to decline. Stears projected the headline inflation rate to decline to around 33.27%. So the numbers came up just a little bit higher than our projections.
Right, now let's take a look at Ghana. This is the fourth consecutive monthly decline. Talk to us about the factors that are responsible for this specifically. I mean, talking about Ghana, you talked about food and non-food items and all of the, but deeper than that.
Yeah, and primarily, Ghana has actually witnessed a decline in service prices. So when we look at service price, you're looking at things like healthcare, education, even like trade as well. So prices along those lines have been reducing, at least compared to where they were coming from last year and even in 2022. Then we're also considering the fact that, when you also like tear down the numbers a bit more, you see that some food items as well have seen considerable declines in their prices. So commodities like maize, vegetables and oils, even cereals to an extent have significantly declined compared to last year. And this has significantly dropped, Ghana's inflation, or at least sustained the disinflationary trend for the last couple of months. But then again, I think the important thing to drive at here is that base effects do have a significant impact on the overall headline inflation rate when you're looking at numbers year on year. And that's why for Ghana, we're seeing favorable base effects significantly, impact their headline inflation numbers.
Right. When you say this, I mean, this is the fourth consecutive month. You probably want to start talking about rate cuts and all of those. But some analysts have actually cautioned against aggressive rate cuts by the central bank. And for them, they're emphasizing the importance of maintaining a restrictive policy stance so they can sort of, sustain the downward trend. You're nodding. That seems to me that you're in support of that.
Well, not exactly. I'm actually listening to what you're saying.
Okay.
But primarily, I would say that there is definitely that room for Ghana to still to make like another rate cut simply because this disinflationary trend has persisted for at least 3 months. The reason why the Bank of Ghana is still very cautious and leaving interest rates at 29% is because they have seen currency pressures emanate over the course of the last 2 months. The Ghanaian cedi has actually been depreciating, and that's one of the reasons why the Bank of Ghana is still quite bullish on keeping interest rates higher for longer. But interest rate cuts are not out of the picture for Ghana simply because at the beginning of the year they were actually the first African country to cut rates to at least support GDP growth. I remember that for central banks to actually take up changes to their monetary policy stance, they not only consider the impact of higher interest rates on the inflation rate itself, but also on output growth. And that's where the application of Taylor rule comes into place. So the expectation is that even if they're going to keep rates high or increase rates or even cut rates, they do it in a way that prices are still decelerating, but at the same time, output is stabilized or at least improving. So at the upcoming meeting in September, we definitely expect that the Bank of Ghana would consider all of these factors. And again, we might see more of their committee members vote for a rate cut in September.
Right. Help us paint a picture of what the business looks like. I mean, what business looks like over there. Because here in Nigeria, we have the Manufacturers Association of Nigeria, business owners, private sector, all of them really just generally warning against elevated interest rates, saying you cannot continue to hike rates. What is the situation in Ghana? What are they saying? And how is it affecting production?
I mean, for almost every African country, interest rates, high interest rates have like they have like almost a similar impact or a similar effect on businesses. So, because when interest rates are higher, lending rates are higher, and that significantly impacts the ability for businesses to access credit from commercial banks, and that has been the case with a lot of African countries, including Ghana. So, when it comes to accessing credit, the high interest rate environment, you definitely expect that we're definitely seeing businesses, make those complaints. And that's why I did mention that at the beginning of the year, if you remember, they did cut rates, and the chances of them doing that again to at least support output growth towards the end of the year, it's a very high probability for them. So of course, businesses are finding it quite constrained or a bit difficult because of the high interest rate environment. But then again, because interest rates have been stabilized, the adverse impact on their operations have not been so detrimental, right? So again, it's just a combination of them managing expectations, inflation and exchange rate expectations across businesses to ensure that confidence is still high. Then you also consider the things that the policy measures and changes that the fiscal authorities are also making to ensure that output and the business environment is also supportive and enabling enough for businesses to thrive in these times where they are taking up reforms and also changing their business, their fiscal landscape, their fiscal and macroeconomic landscape to suit the IMF programs that they've undertaken.
All right, let's come to Nigeria now. You already said you sort of expected a figure. Now, what does this mean for the average consumer? Before we even come to that, is this deceleration commensurate, when you look at the prices of goods and services? Can we say that commodities were actually cheaper last month? Because this particular figure points to last month.
Yes, I mean, that's one of the reasons why I mentioned the impact of base effect. So base effect doesn't really consider what exactly is happening the month before, and that does impact the computation or the modeling of inflation numbers generally, not only in Nigeria, right? So if you're coming from a high base the previous year, right, in that particular month, and that's exactly what happened in July 2023, where we saw the rate of increase in inflation significantly increase when you dissect the month-on-month numbers. And that happened because of the reforms that we took up at that time, and the impact that had on the broader commodities market, food market, and on energy prices as well, right? So because those shocks are not present anymore in July 2023, in July 2024, that's why we're seeing the headline inflation decelerate compared to July 2023 last year. Then when you also compare the July month-on-month inflation with the June 2024 month-on-month inflation, you see that the decline was pretty minimal. And then again, you also now have to consider what exactly, nudged this decline in prices. So first of all, we saw that the food inflation rate actually, cooled just a little bit. And then we also saw, and that somewhat to an extent was driven by the harvest season. Because if you remember, in July, we did see, at least to a moderate level, we saw tomato prices decline a little bit. We saw the price of pepper as well decline a little bit. The price of onions decline a little bit. And all of this were primarily attributed to the harvest season, right? Then you also consider the fact that when the NBS is collating all of these numbers, this process happens within the first 2 weeks of the month, first 2 to 3 weeks of the month. And coming from the end of June up until the first 2 weeks in July, we did see the Naira somewhat stabilize at around 1,500 to 1,520. So the shock to the exchange rate was not as much up until the third week of July, towards the end of the month, entering into August, before the retail auction that happened with the CBN to clear the FX backlog. So point is that there are enough there is enough, macro factors backing the fact that the inflation rate did see a decline, right? The headline numbers are clearly, evident of base effects. The month-on-month numbers are evident of the slight decline in food prices during the first few weeks of the month. But then again, it's also important to take a look at the other part of the inflation numbers. And that's where you look at the core inflation rate. And that tells us the underlying inflation rate in Nigeria. And coincidentally, that increased, right, month on month and even year on year. And what does that tell us? It tells us that the underlying factors that are still, impacting Nigeria's inflation are very prominent. So what that tells us that, number one, exchange rate pressures still have an impact on inflation and general commodity prices. It also tells us that, low agricultural sector productivity, insecurity, high logistics costs, high distribution costs, all of those things are still very much prominent, especially from the supply side of the economy, and that is having an impact on prices. Yeah.
All right, I was going to ask you about core inflation, because when you talk about headline inflation, we saw, that decrease month on month, year on year. But when you come to core, whether it's month on month or year on year, it's sort of, it's even increased. But probably, I guess you've sort of tried to mention that a bit, but because we're pressed for time, let's come to food inflation now. We also saw a decrease from, 40.9% in June to 39.53% in July. I do not know if this excites you, but it seems the import duty waiver, is probably becoming a thing now. How effective do you think this measure will be, and what other policies, should be considered?
The import waiver, it kicked in on the 14th of August, and it's going to last up until December 31st. So actually, it's not yet, evident in the inflation numbers for food, at least
it's a
in
projection,
July.
I'm asking, yeah.
Yes. So I get that. So for the projection, basically, we do expect that would have an impact on the headline inflation numbers and generally food inflation numbers over the coming months, right? We also do expect that coinciding with base effects as well will also have an impact on the general, inflation rate, and as well food inflation numbers. Then again, you also have to consider that the harvest season is still ongoing, right? Harvest season is almost all through Q3 and to a large extent the beginning of Q4. Right. So that as well. So the combined impact of all of this, we do project that inflation rate is going to keep decelerating, maybe not by so much, but at least we will see that taper down. And we'll definitely see food prices decline. The important thing here is that while we might see this happen, we might not see like a substantial increase in, disposable income, because people's incomes are still stagnant, at least compared to the beginning of the year and even last year, right? So their purchasing power is still slim, and we would not see panic buying of these commodities when prices are reduced, simply because the measures that have been put in place are going to last up until the end of the year. Going forward from 2024, then we can now start having the conversation about sustaining these measures to ensure that at least the price abating impact that it's having in the overall commodity space is sustained for a longer period of time, to at least allow consumers, recuperate from everything that has happened in between 2023 and 2024.
Right, in 30 seconds, when should Nigerians expect maybe a rate cut or hold? Should that happen this year?
A hold decision maybe this year, a cut not likely this year, simply because the central bank has already stated that they're going to keep, interest rates high for as long as possible until they see a space of sustained deceleration in inflation rates.
Right, there's still that conversation about balance. Well, we don't have all the time. We'll talk about that some other time. Dumebi Oluwole, Senior Economist, Stears, thank you for your time and thoughts on the show today.
Thank you for having me.